Our next guest says despite virus flare-ups that we're seeing across the country, stocks are still headed back to all-time highs this year. Marco Kolanovic is a global head of macro, quantitative, and derivative strategy at J.P. Morgan. He joins us on the Fast Line. Marco, always great to speak with you.
Hi, Melissa. How are you?
So you think that the flare-ups are just hiccups, and you're really pointing to the lower mortality rate, so you're not dying, and so that makes you more confident?
We have a number of things happening in the market. One is first the stimulus. The second is really whether the COVID is going to end the economy, and we don't think it's going to end the economy. We think we are seeing now a bit of a second wave, but mortality in the second wave should be much lower. We're also monitoring some of the smart thermometer data and basically seeing much smaller spike than what we saw sort of in March and April. So we think it's a little bit of a step back, but we are on a path to recovery. Economy is on a path to recovery. So
your year-end target is 3,400. And what sort of progress do we need to make on that vaccine? Is that one of your primary, base cases for 3,400 that we have progress towards a vaccine and then maybe unemployment?
Okay. No, not at all. Not at all. We really don't condition it at all on a vaccine. Basically, on one side, we are looking at the impact of monetary and fiscal measures. And on the other side, we're basically looking at some limited reopening the economy that does not require a vaccine.
So it sounds like there could be upside potential to your 3,400 target. I mean, should we make some pretty decent progress to the vaccine? If that's not factored in whatsoever, that could be a real booster.
I agree. So if there is a progress of vaccine, which we do not factor in, I think you would just see the quicker snapback. You would just get there quicker, much quicker, so we are, you probably overshoot, so we are talking here about 3,400. I think if you can accelerate everything, I think you would probably go to about 3,400, call it 3,700. One big driver of our view is also positioning. Positioning in equities is actually very low. So it's about 25th percentile across discretionary hedge funds. If you look at the quants, it's actually even much lower. So for instance, all of these volt targeters, risk parity, even CTAs to some extent, they're between 5 and 10 percentile in. So just the decline in volatility, if you can just normalize a little bit markets, actually money will flow into equities. So that's another big driver, which is entirely independent of COVID.
Hey, Marco, it's Tim. Congrats. You guys have done a great job on having a level head in the chaos and talking about positioning and then talking about this unprecedented level of stimulus. And so back to then, let's talk positioning. You just hit a lot of it, but at times you've given us some specific levels if CTAs overshoot on a couple headlines that we could get. Can you give us some near-term guideposts on where you think some of the shorter-term overshoots could be?
Yeah, so look, with the CTAs now, and that's something that's not very well understood, I think, in the market, signals are largely positive. We are above 200 moving their average. We're above some of the other fixed tenor signals. So signals are positive, but what's holding back these investors is high levels of, call it VIX, high levels of realized volatility. So signals are already positive, but because volatility is high, these funds are only maybe like 15 to 20% invested on the trend side. So basically declining VIX would just you would just see an increase in assets going into equities, funds going into equities. So I wouldn't tie it to specific price level, but more decline in VIX. So let's say VIX can go into mid-20s, and maybe by the end of the summer, sort of low 20s, then I think you would just pour in, probably a few $100 billion in equities, which in an environment of low liquidity could push market quite substantially above these levels.
All right. And Marco, while we have you, just a quick question. We've been talking about the rise of the retail trader, and I'm just wondering if in your sort of world, if that factors in at all, their liquidity that they're adding into this market.
It does factor a little bit, So I would say the assets, assets are not huge, but their impact can be larger. Like the market impact of these trades could be is probably larger than institutional trades, and assets are flowing in. People are getting these paychecks. They're staying at home. They're doing it as a pastime instead of betting. So actually, definitely helped. And we think that money will stay in the market. So that's another thing which I think is a positive.
All right, Marco, thank you.
No problem.
Marco Kolanovic, J.P. Morgan. Dan, Marco said the magic number on volatility VIX is mid-20s, low 20s this summer.
Yeah, I mean, it could be. I mean, obviously, it's really about monetary stimulus. I think that's the thing that sticks around. I think fiscal is going to be harder to come by. I just remember last time he was on the air or on our show with us, he was a little worried about the tensions with China. To my purview, they're not getting better, and they're only likely to get worse. And especially as the president's numbers are as bad as they are, he needs to beat up on something. So I suspect that situation is not going to be particularly good, and that could be a real headwind to growth or global growth at a time when we just need it to kind of putter along, and we need to kind of unify. So to me, that would be the big headwind that I see.
Grasso, quick comment.
I think he's right. I think you're going to overshoot those old highs. I think you're going to shoot straight to 3,500 from here. Between monetary, fiscal, and reopening the economy, those three things are going to have the ability to be a tailwind for the overall market. I think the easiest path is still higher.